This is Ken Rosen from the Fisher Center for Real Estate at UC Berkeley, Haas School of Business. And today I'm going to talk about COVID-19, the induced economic coma that we've been in for the last 3 months, and the beginning of the reopening, and what path to recovery we may have. So our summary on the economy is that all 50 states and many countries around the world had been in this coma, and now they're reopening. And the reopening after the Great Shutdown, even though we still have rising infection rates in almost half the states in the U.S. and many of the countries where they're reopening. The world's in its deepest health crisis since the 1918 Spanish flu. And since we don't have a therapy at this point or a vaccine, we use this policy of basically lockdown. People were in an induced economic coma that they shut down consumer and manufacturing activities and let some essential activities like groceries and pharmacies and banks stay open. And this has caused us to be in a recession. We had a negative GDP in the first quarter of this year just because of the second half of March. And we're going to have a big drop in GDP in the second quarter. We don't get those numbers till July, so we won't know how big it will be, but somewhere in the order of, we'd say 20 to 30%. We don't really know. And GDP is a funny number anyway. We've already lost first unemployment claims now at the numbers up as of today, June 4th, to 42 million. That's a very large number. And it's the fastest and deepest slide in the global economy and financial markets that we've had since the 1930s. The government has done two big things to try to cushion this, to give us medication while we were in the coma. The first was the CARES Act, a $2.5 trillion, what is labeled a fiscal stimulus program. What it's attempting to do is to make whole the households and firms and institutions that have been affected by the government order to shut down. And the question is, will it be timely and effective? And so far, I'd say it's covered a lot of people, but a lot of firms and people have fallen through the cracks. On the consumer side, there's been a $1,200 payment per person stimulus check. In addition, for those who've got less than $75,000 income. But the most important provision is the supersized unemployment compensation, where you can file for your state unemployment compensation, and the federal government gives $600 a week in addition to that. It's overwhelmed the system. It's also allowed self-employed and gig workers and others to apply who normally would not qualify. And so this is a very big program. The processing times have been long. People filed and wait 3, 4, 5 weeks, and many people, maybe as many as 25% of the people haven't got their money yet. But it is a big program. Obviously, undocumented workers aren't covered, and many others have been fallen through the cracks. But it is, I think, the main stimulus that we're trying to protect the consumer. For companies, small companies have been able to apply for something called PPP, which is meant to support the payrolls of small companies. Initially, that had put out about $300 million. Another $200 million has gone in, so about $550 billion. I'm sorry, not million, $1 billion has gone in. These loans are forgiven if 3/4 of the money is used to keep people on the payroll over the next 2 months. Now, Congress yesterday passed the extension of this bill to allow a longer time period of repayment and to reduce the portion that has to be used for employment retention to 60%. Assuming the president signs it, that'll make the program a little more flexible. And this has helped many small businesses, but unfortunately, many will go out of business. We think as many as 25 to 35% of small business won't make it back. The Fed has also been very aggressive, and they've cut interest rates on the short end to basically between 0 and 25 basis points. They've begun QE4, which is unlimited buying of bonds, and residential mortgage-backed securities. They've set up something called the TALF program, which is a term asset-backed securities loan facility where they're buying basically everything from CMBS to other types of securities to stabilize that market. They've set up a Main Street lending program. They're participating in stabilizing the muni debt market, the money markets, commercial paper, the repo market. So they've surged money into the system, and it has done a good job, I think, of stabilizing the financial system at this point. I think it's likely to see another fiscal program because missing from the benefits here was enough benefit for hospitals and universities and state and local governments. So we're likely to see one more tranche of this at least, and possibly an extension of the unemployment program, which really ends in July. Same thing with PPP, so we may see extensions. But the question is this enough? We've been in this induced economic coma, as now we're coming out of it. How quickly will we recover? How can we do the reopening when we haven't got virus containment? That was the whole purpose of this program, not only to flatten the curve, but also to stop the virus. So China, Taiwan, New Zealand, South Korea have been able to stop the virus completely. And so if what they have done can be replicated here, we could see that many of the virus issues could be gone by the end of the summer. But unfortunately, we're reopening without containing the virus. So we may well see a surge of cases again. And we've lost 107,000 people so far in the U.S., and it could well go higher substantially over the next several months. There's a lot of uncertainty in the forecast, and that's going to make a little bit of my talk difficult. Usually I know exactly what's going to happen, a little facetiously there, but I would say the uncertainty is about the virus, and the recovery is about the virus and how the economy responds, not just how government responds. So now we're going to look at the confirmed cases by country. And you can see the U.S. has obviously outpaced the rest of the world in cases, rising very dramatically. Remember, this has only been 90 days, and we're the highest in the world. I think we've not done a good job on containment. The social distancing worked well in Northern California, but other places it did not work well. The lockdown wasn't complete enough, and the reopening looks like it's too soon. If we look at the other countries there, you can see Brazil surging and probably will surge past us, but Hong Kong, South Korea, mainland China have flattened out completely. If we look next at by state, the COVID cases, you can see a huge discrepancy around the country. New York City, and New Jersey devastated, a rate almost 10 times that of California and Florida rates. So we have been very fortunate here. I think we've done a better job of locking down early. But New York, much of that was seeded from European travelers, and the whole New York metropolitan area has seen the biggest issues. Obviously, things are improving substantially there, but it's still been devastating to those markets. Next chart just looks at where are we in the COVID case, new infections being reported. And in the U.S., we are certainly down a little bit, but we're still seeing very big increases per day. We've taken New York out of this because the peaking would be bigger because of New York, but we wanted to see what it looked like around the rest of the country. So we're not at all solved. And unlike Italy and Spain and New York itself, which has dramatically come down, the rest of the country is still experiencing big outbreaks, and over 17 states now have rising infection rates. Why do we care about this? Well, as the next slide shows, mortality is so high for those older groups. And that is, I think, why people are so worried. The lack of a vaccine, the lack of therapies to stop this, unlike the seasonal flu, has made people very worried about their own personal health. On the economy side, the next slide just shows you that we've had a surge in unemployment as we've locked down the economy. And it's both nationally in California. The biggest surge happened when we first locked down in late March and through the middle of April. And we lost so far 42.6 million jobs in the last 11 weeks. Those are people who file for U.S. unemployment claims. And remember, this is a somewhat inflated number because we expanded the program to include people who normally can't file, self-employed people, gig workers, and others. But it's still a very large number. In California, the number is also huge. The implied unemployment rate is in California close to 30%. Now, I think that exaggerates the number because, again, as I said, the additional people applying, but still the number is over 20% for sure. There is some green shoots here. We've seen in the next slide that continuing claims have fallen a little bit nationally as we've reopened the economy. People are being rehired, and I think we should expect this to continue. We've probably seen, at this point, barring a big second wave of the virus and reclosing down, we've probably seen the bottom of this in terms of job losses. There'll still be more. There could be another wave from state and local governments and the like, but we think we've seen the worst of the job losses in terms of absolute numbers. As slide 9 shows, we've lost over 20 million jobs based on the establishment survey, 40 million based on the unemployment claims numbers. The new establishment survey number comes out the first Friday of each month, and it's likely to go up substantially still. But this is wiping out the entire job gain from the recovery from the Great Recession in 2008 and 9. So we've lost all those jobs that we got back. And if it wasn't for the unemployment compensation and the stimulus checks, we'd have much more adverse situations. So at the moment, as we come out of the coma, the medication has kept us alive. But it's really differentiated by income class, as the next slide shows. The low-income service workers who work in hospitality, in restaurants and bars have really been hurt really badly by this situation. Almost 40% of the people have lost their jobs in that situation. The upper income groups who can work remotely have been working remotely and much smaller job loss, but still substantial, but much smaller job loss. So to summarize this, what is our pandemic recession outlook? And we know that it's highly uncertain at this point because it is about the virus and the second order effects that are yet to come. But we think that we are bottoming at the moment, and by the third and fourth quarter of this year, if you look at that lower portion of the slide, we expect to be regaining jobs. And we think we'll regain roughly half the jobs lost by year end. But that assumes we don't get a big second wave of the virus and go back into a lockdown situation or fear situation where people pull back again. So that's a pretty big assumption. It also assumes that we extend the unemployment compensation for another 3 months and extend the PPP for another 3 months as well. So in that scenario, we see the unemployment rate peaking at 22.5% roughly, and then dropping back. And then assuming we get a vaccine by 2021, we get a much more vigorous recovery and move that unemployment rate back to 6.8%. But it is about the virus. The Fed is going to keep interest rates close to zero on the short end, and that's our forecast. And then they'll start edging up in 2021 as we recover. The long bond, which is about 80 basis points today, we think will edge up next year, again, as we get recovery in the economy and have the virus problem solved. But the Fed is going to be aggressive at keeping rates lower for longer until we really get the economy on a more stable path going forward. The recession is here. We're in the middle of it now. One could add your bottoming and job loss, but that doesn't mean the recession technically isn't going to be here. We've had basically we're going to have 2 quarters of negative growth, sharp recession. As we start recovering, you could say we're getting out of the recession, but it's going to be a long path to recovery, as the next slide shows. This is an inverted Nike swoop, as you can see, bottoming now. But basically a stair-step recovery, not a V recovery, taking basically almost 2.5 years to get back to full employment situation. So it's going to be a long slog to getting back to where we want to be. Again, what could change that? The virus stops and we get a vaccine. and all of a sudden people can burst out again. So that could make things better sooner. Slide 13 just talks about the obstacles to the path to recovery. We may be opening too soon and not carefully enough, so we may see rising a surge of this virus again. There's no quick return to normal, I think, because the V is going to require us to forget about what happened. And I do think we have what I call pandemic shock syndrome, that we're going to basically, people are psychologically damaged by this 11-week lockdown. They're financially hurt badly. The same thing is true of firms. So it's going to take a longer time to get over that. They're going to be cautious. People and firms are going to be cautious, rebuild their confidence in what goes on. And many small businesses just won't make it. They're going to have gone bankrupt. Large firms are having, reduced earnings, increased costs to deal with the fallout of this. And so even though they borrowed lots of money and got money from some of the government programs, it still doesn't feel like it's going to be a quick rebound. We also had weaknesses before COVID. We had a tech bubble here in the Bay Area. A lot of these startup ventures were funded. We're never going to make profits. We saw the fallout from already in October and November from WeWork's failure to go public. It was a flawed concept to begin with. Many of you heard me say that over the last few years. But we have a whole bunch of companies that we're never going to make it. So venture capitalists and other investors are going to be much more cautious, look at path to profitability as they should have all along. We also had too much leverage in the system. We put on a lot of loans at the bottom of the investment grade area, and they're going to be downgraded. Agriculture already had a recession. We have had a trade war with China, which continues at this point, despite Phase 1 agreement. That may be vitiated, but basically I think we have a lot of negatives going on still in the economy. And yes, fiscal and monetary policy are trying their best to cushion this, but they, basically have done about all they can do at this point. And deglobalization is going to impede the recovery. We've now, by executive order, stopped legal immigration to the U.S. Remember, legal immigration accounts for almost half of our population growth. And business investment is going to be curtailed. People are just pulling back on capital expenditures, trying to build cash. The next slide just talks about the risks in 2021 and the rest of this year and next year. And I think the biggest one is about the virus. Are we going to get a second wave, a surge after the reopening, and then a second wave of virus reoccurrence in the fall and winter? And that would put us back dramatically. As you can see from the box, we're in recession now, both technically, and you'll see the confirmation of that in July. And we might go back in a situation. It's not clear that we get out of it. So we still think that 2021 is problematic. U.S.-China relationships at a low point, both in trade and political tensions, and Hong Kong is the explosion point. So we do think there's a lot of risk in that relationship. We have an election we may have forgotten in November, and that could lead to substantial policy reversals in 2021. That could mean higher taxes, more regulation, and markets might not like that. Of course, recently we've had this urban civil unrest, very unsettling. And again, I think that's delaying the reopening and delaying confidence in the economy. And of course, there are real social justice issues there as well. State and local governments have big revenue shortfalls. And same thing with hospitals and universities. And we could get a second wave of layoffs and service cutbacks and tax increases unless there's aid coming from Washington in a big way. And I'm worried that we may not get what we need there. I have all talked about the technology issue, technology valuation bubble, and the capital markets correction in those startup ventures, which are large. Inflation right now is zero, as you saw in our forecast, but it could come back with a vengeance because of all the money that's being printed around the world. Did not happen after the great financial recession in 2008, 9, and 10. All that stimulus did not create it, but this time it could happen. And interest rates are so low today, we've got a bond market bubble. The Fed has engineered rates low, as the central banks of Europe have. If we ever return to normal, and I say ever, I think we will normalize rates at some point. The 10-year bond could go back to 3 to 3.5% in a 3% inflation world. If that happens, the unwind will be quite messy. A lot of geopolitical risk out there. We forget so much has happened that the Saudi Arabian oil fields were attacked by Iran in September. Did not trigger a wider war, but obviously could at some point. Iran's a wild card. Brexit's still in process. The Kashmir, India-Pakistan border obviously has a lot of tension with India closing down on parts of Kashmir, taking over. China at the border there's skirmishes going on with India. So there's just a lot of spots that we worry a lot about. And the deglobalization, we think, is a pretty big risk. Bay Area specific risks, we have a problem here, and that's our high cost of both home ownership and rental housing. We're the most unaffordable market in the U.S., and I think it's already begun to impede growth the last 3 years, and I think it's going to continue to be a major problem here. A lot of initiatives coming out of Sacramento and local initiatives, but it's a very hard problem to solve with our local land use policies. In addition, we are shooting ourselves in the foot by putting in policies that are anti-landlord and make it less desirable to build and own new housing. Statewide rent control was passed by the legislature. A CPI plus 5% adjustment is maximum allowed in every place in the state, and lower levels are allowed in certain municipalities that already have rent control. And on the ballot in November, there's an initiative to put on statewide vacancy control. What this means is that if someone leaves their apartment, normally you're able to raise the rent to current market. You'll no longer be able to do that. It'll be limited to 15% over 3 years. So this is guaranteed to make if these things continue, make the affordable housing problem worse, not better. They labeled it affordable housing, but it's the opposite when you make the incentive for housing investment lower. The quality of life issues in the Bay Area have become very important and very negative. We have the homeless problem, which is people living off freeway ramps and on streets, and it's not compassionate at all. This is an awful situation for the homeless. We need a right to shelter law, mandatory mental health and substance abuse treatment. We need a political courage here, and we need to do this now. It is untenable to leave people in tents, and it's obviously negative for Bay Area businesses and quality of life, but it's most negative for those people who are homeless and need mental or drug abuse treatment. Other issues, mass transit is going to be used less as long as we have this virus. Once we reopen, the traffic congestion, which was already horrible, might get substantially worse. And of course, the urban crisis, the political and social turmoil we have a number of issues here in the Bay Area. We're relatively good compared to other places, but I think what we've seen in recent weeks has again made people very uncomfortable living in some of our urban areas. And specific local policies, San Francisco is doing its best to close down businesses. Development fees for a new unit in San Francisco are $120,000. Oakland, much more attractive, but still $28,000. Various office propositions, Prop M, Prop B, discourages needed office space in San Francisco. San Francisco recently put a tax on vacant retail space and attempts to impose rent control on short-term housing. And they basically put in place various taxes on the business sector to fund things they need. The huge budget deficit in San Francisco is probably going to encourage more of that. But the fact is, San Francisco politics, from the point of view of treatment of business and free market housing, is dysfunctional. And they made it increasingly difficult for commuters to come into the city. So I think this is going to hurt the goose that laid the golden egg. The Bay Area has been the goose that laid the golden egg, and we're doing our best from a public policy point of view to make it a less attractive place. There's also other changes that I think are very important. The biggest one is the change in federal law, which limited the deductibility of state and local income taxes to $10,000 per year. And of course, that's quite a negative thing, increasing tax rates for everyone in California. And that has led to outmigration, which is already happening and substantially increasing that. Finally, the earthquake, as we know, is going to come. The big one's coming. We just don't know when. It's a risk. So the outmigration in the Bay Area, as you can see from the next slide, has been substantial. This is domestic outmigration, roughly 50,000 people a year leaving net the last 3 years, and this is before the real impact of the tax law is felt. So we are losing people net, and if we added international migration, the net loss is not as bad, but still substantial. Slide 17. The difficulty here is that the lockdown that the president has imposed on legal immigration will very adversely affect San Francisco, L.A., Houston, Miami, New York, cities that bring in lots of wonderful international immigrants who make our vibrant economy happen. So this is a big, big problem. So let's look at the San Francisco economy in more detail. The next slide just shows you we've lost 200,000 jobs in this COVID-induced recession. Our unemployment rate was about 2%, is now 12.5%. And if we move to East Bay, the same sort of thing's happening. 179,000 jobs lost, 14.9% unemployment rate. And Silicon Valley, 138,000 jobs lost, 12.5% unemployment rate. So this is the great recession bordering on depression. So looking at the multifamily market first, just a couple of real estate sectors. This environment has led to lower leasing because of the shelter in place. As we reopen, we're seeing leasing improving. But again, the large job losses have led people to move back in with their parents because they can work remotely from that location, or to double up as people leave the Bay Area. And again, the counterintuitive effect here, we put moratoriums on evictions if you don't pay your rent, not tied to losing your job. So I think this is a big issue. When the moratoriums expire, as they will, we're going to have a lot of people who owe back rent. But surprisingly, the last 2 months, April and May, has shown that most people have paid their rent. It's about a 3% reduction, but over 90% of people have paid their rent in April and 89% in May so far. So that's, again, a very big positive. Next slide just shows you that permits for new construction have been elevated the last 3 years in the East Bay. We're building a lot of units. Many people don't think it's enough, but the vacancy rate's been edging up, as the next slide shows. And rent growth through the first quarter of this year has been about 2.6% in the East Bay, but now it's turned negative. We're getting free rent as people occupancies are declining, and I think that's going to be true through the rest of the year. San Francisco also, the last 5 years, has built a lot of units compared to history, but again, nowhere near enough to alleviate the problem. Slide 26 just shows you the vacancy rate in San Francisco rising slightly, but I think when we get the actual numbers through the COVID crisis, vacancy rates from East Bay, San Francisco, and Silicon Valley are all going to jump. Rent growth was 1.7% per year before COVID. After COVID, my guess is going to be negative. We've seen reports of negative 3 to 5%, and some high-end markets 9% down. Silicon Valley, again, quite a bit of construction the last few years. Slide 28, vacancy rate edging up, and rent growth 2.8% before COVID. Again, we think it's negative as we go through this rest of this year. House prices, slide 31 shows you that East Bay edged up last year. With the COVID crisis, there was a shutdown in April and early May, but now it's picking up again. We think house prices are going to be flat to plus or minus 5%, depending on what market you're in. San Francisco, same thing. House prices were flat the last couple of years, but plus or minus 5%, depending on what submarket you're in. and Silicon Valley, which had a very huge price increase in the middle part of the decade, saw a price decline in 2018, price correction. We think, again, is probably plus or minus 5% going forward, not a very big move at this point. Finally, the office market availability in the East Bay has come down. We've had a very strong economy. But the real question is, what are people going to do when we reopen? Right now, people are not in their office space. As we reopen, are they going to take mass transit? And are they going to go back to the office space, or are people going to work remotely in a larger portion than before? Many of the big tech companies have suggested that they're planning to do that. So we'll have to see if that happens. Rents in, again, East Bay, which is primarily Oakland and San Ramon and Walnut Creek, have been up a lot of the new space. But again, my guess is with the decrease in demand post-COVID, we could see rents decline 5 to 10%. San Francisco had been the tightest of the markets. Vacancy rates had been in the 5% range, started to go up already. We think a lot of sublet space comes on the market as more people work remotely, and a lot of the tech startups are going to lay off and not have anywhere near the growth they have. They're going to lay off people. Rent in San Francisco had gotten very high. It basically almost tripled from the bottom of the cycle, but it's weak now as all the sublet space comes on the market. And finally, Silicon Valley, which had been a very strong market, large campuses. We think that that again is going to reverse as more people in tech companies especially work remotely. So we'll stop at this point, and I thank you all for listening, and I hope this gives you some view of where things are going. I wish we could have done this in person. This was the first meeting that I had that was canceled when COVID appeared about dramatically the week before. So we are sorry we couldn't do it in person, but hopefully next year we will. Thank you.